e.l.f. has crashed 25% since their heights in March. But despite this recent pullback, the stock has still delivered more than 1,200% returns over the last 5 years and could easily outperform the S&P 500 over the same time frame. With their focus on social media marketing, they are hugely successful in catching their target audience in Gen Z, and they are the favorite beauty brand in this age group. But can they continue this insane growth story? Or is the recent dip the first indication of weakness? If you want to know if you should add e.l.f. to your portfolio, stay tuned, because in today's video I will dig into the business models and the markets of e.l.f., analyze the strategic position by doing the Porter's 5 Forces analysis, and have a look at the latest financial statements to see how they are doing. I'll also check the valuation and do a discounted cash flow calculation to determine their fair value. In the end, we will see if e.l.f. is a good long-term investment for us or not. My name is Florian, welcome to my channel. e.l.f. Beauty has the ticker symbol of e.l.f. and they are listed on the New York Stock Exchange. They are working in the consumer staples sector and were founded in 2004. They have around 340 employees at the moment and their headquarters sits in Oakland, California. The market cap sits at around $9 billion right now. The company e.l.f. Beauty actually owns a couple of different brands. First of all, we have the e.l.f. brand, which actually stands for eyes, lips and faces and provides beauty products for exactly this. Then we have the e.l.f. Skin product, where they focus more on clean skincare products. We have the Well People brand, which focuses on plant-based beauty products, so basically vegan beauty products. We have the Keys Soul Care brand, where they cooperate with Alicia Keys and not only focus on beauty, but also more on lifestyle products. And last but not least, we have the latest acquisition, which is the Naturium brand, which focuses more on high performance and accessible skincare products. So e.l.f. can provide products for all different segments within this beauty industry, and they are represented with a couple of different brands over all of these segments. But not only that, with their target audience mostly being the Generation C, they are also focusing very much on affordable products that still have a very high quality. So here you can see in the last earnings slide, they compare a couple of their products with their price. In this example, we have a primer from e.l.f. for $10 that compares to a prestige primer with a price of $45 US. And the same we have for a couple of different products. So the cost of the e.l.f. products compared to other competitors on the market is quite cheap. But not only that, they are not only focusing on affordable high quality products, but they are also focusing on providing these products cruelty-free without any animal testings. And they are even donating at least 2% of their yearly profits to non-profit organizations. So a huge part of the brand value of e.l.f. is actually their reputation of being a high quality, affordable and very fair company. As a US company, most of their sales are coming from the United States, and internationally they basically only have the UK market and the Canadian market that they already explored with a quite small share. And here we can see that actually the US makes up the vast majority of their turnover, at least in the last 9 months. Just last summer, e.l.f. announced the acquisition of the Naturium company. Naturium focuses on the same aspects that e.l.f. does and has powerful and ingredient-led products in the skincare industry, while also focusing on a low price point. Actually, Naturium is one of Target's fastest growing skincare brands. And with this acquisition, e.l.f. could basically double the penetration in the skincare sector from previously 9% with only e.l.f. to currently around 18% market share when we combine e.l.f. and the Naturium products together. One of the cornerstones of e.l.f.'s success is actually their marketing. And they are really putting a huge effort and huge costs on their marketing activities. In this graph, we see the marketing investments as a percentage of their net sales. And in the fiscal year 2019, it was around 7%. And in the fiscal year 2024, they expect to bring this up to 22 to 24%. So they are really pouring in the money into their marketing activities. With these activities, they are actually mostly focusing on social media marketing. First of all, by doing product collaborations with other companies. For example, here we have Chipotle or Dunkin' Donuts. but also by working together with many influencers, especially in the Instagram and the TikTok space. And when working together with influencers, they are rather trying to work together with smaller influencers. Here we can see this blue bar is by far the biggest market share which creators they work with. And these so-called micro-influencers have around 10,000 to 100,000 followers. I think this is one of the bigger success points for e.l.f. because these micro-influencers are perceived as being more authentic and being more honest compared to the very large influencers. And a lot of what they do here is basically testing their products and also comparing the products to more expensive, more luxury brands. And to show that the performance of the e.l.f. products is basically on par with these more expensive products. And this kind of marketing seems to be very successful. When we look at the market share, we see that e.l.f. could grow the market share by 330 basis points compared to a lot of their bigger competitors, which lost market share over the last year actually. So at the moment, e.l.f. seems to be very successful in stealing market share, in winning customers from these more luxurious, more high-end perceived products with their market language of being the affordable and fair company. Besides being highly effective in their target customer group, despite being highly effective with their target audience, this social media and digital marketing is also way cheaper when we compare it to more conventional marketing campaigns. How effective this marketing really is, we can see when we look at the Piper Sandler market report taking stock with teens, where they looked at all kinds of different market trends, especially with teens. And for the favorite cosmetic brands, over the last couple of years, since spring 2022, we can see that e.l.f. has been on the #1 spot. But not only could they defend the #1 spot, they could even increase the distance to their competitors. When we look at the percentage of female teens that have e.l.f. as their favorite beauty brand, the percentage is actually going up on a year-over-year basis. And right now, around 30% of all female teens have e.l.f. as their favorite beauty brand. This success can also be seen with the sales space e.l.f. gets in different kinds of convenience stores. And the amount of space designated to e.l.f.'s brands has been increased for Target, Walmart, CVS, and Shoppers Drug Mart in spring of 2023. In fall of 2023, it was increased in the Ulta Beauty, CVS again, and also Walgreens Market. And in spring of 2024, it was increased at Shoppers Drug Mart and Boots. Not only can e.l.f. increase their market share within this beauty market, but the beauty market in total is also expected to grow over the next couple of years. And here in this market report from McKinsey, we can see that the global beauty market is expected to grow with around 6% CAGR over the next couple of years until 2027. Even though this is not a huge growth numbers, we can still say that e.l.f. is operating in a market with a secular trend. What I also found quite interesting, and this statistic is again from the Piper and Sandler report, is the regularity of the use of beauty products. This yellow line especially indicates the female teens that use beauty products every day. And since spring 2021, we can see that this trend is going up very steeply. You might argue that this market trend is only because we had COVID before, and during COVID everybody was sitting at home and didn't need makeup. But this is not true, because if you look at the numbers from 2027 up to 2020, it was also declining. And only after COVID, it did pick up speed quite significantly again. Right now, more than 50% of all female teens are using makeup every day. And again, around 30% of these people actually have e.l.f. as their favorite beauty brand. When we look at the strategic position of e.l.f. by doing the Porter's 5 Forces analysis, first of all, I would say that the threat of new entrants is quite low. There are many smaller brands in the beauty industry available, but by now, e.l.f. has already quite some market power due to the size and brand name. The entry barriers for this industry are also quite high due to the high capex costs necessary for manufacturing and R&D of these products. The threat of substitutes, on the other hand, I would expect is quite high. The switching costs in this beauty industry are very low, they are basically not there, and there are so many different options to e.l.f.'s products easily available from a plethora of different competitors. And even though e.l.f. is currently building up its brand name and it's gaining market shares, there are still bigger and better known players out there. The usually low costs of e.l.f. products do help alleviate this threat a little bit. The competitive rivalry in the beauty industry is also quite high. Again, we have many players in this market and some of them have even bigger market shares compared to e.l.f. There are also no switching costs, and the bigger players such as Maybelline or L'Oreal are fighting fiercely for their market shares. The bargaining power of their customers I would estimate as medium to high. Again, there are no switching costs and the products in the beauty industry, even from different brands, are very similar. The usually low price of e.l.f.'s product does give them an edge here because their target audience with teens and young adults, they don't have so much money and they rely more on these cheaper alternatives compared to the premium priced products. The bargaining power of the suppliers, on the other hand, I would estimate is quite low. e.l.f. has a wide range of suppliers for raw materials all over the world, and the needed raw materials are also mostly commodities and are basically easily available. So overall, it seems that the moat of e.l.f. is not that high. There is fierce competition in the beauty industry, and all of these products are very, very similar. The customers also don't have any switching costs, so if customers do not like any brand language anymore, they can easily switch to a competitor. Right now, e.l.f. is riding this wave actually, but there is no guarantee that e.l.f.'s competitors also jump to the same marketing strategies, to the same brand language, and basically trying to copy e.l.f.'s success to a certain degree at least. If you do like the video so far, and if you do like this kind of analysis, where we focus not only on the key numbers, but also on the more qualitative aspects of a company, please smash the like and the subscribe button in order not to miss my next video. Even though we had quite some dip recently in e.l.f.'s stock price, the performance over the last year was quite impressive. With the total return of e.l.f. compared to the S&P 500, they could easily outperform S&P 500 by almost 3 times. Over the last 5 years, this is even more impressive. Here, e.l.f. could deliver returns of 1,300% compared to the around 100% of the S&P 500. The financials of the company also look quite nice, with a total revenue growth of 27% CAGR over the last 5 years. Here we can see quite a steady growth, although in fiscal year 2023 we definitely had quite some outperformance compared to the previous years. We can see a similar trend in the net income and the free cash flow, but in this case the numbers are fluctuating quite a bit more compared to the revenue, and only in last year we had a big jump. Still, the CAGR growth rates over the last 5 years are 14% for the free cash flow and 40% even for the net income. For the margin, it's also very nice to see that since 2021, the company could basically increase their margins on a year-over-year basis, but these margins are still a bit lower compared to many of their competitors right now. The EBITDA trend for e.l.f. looks very similar to the net income. Here we can also see that the numbers has been fluctuating around a little bit, but since 2021 the company had a very nice uptrend. But of course this has only been for the last 2 years, so we need to see if they can continue this trend or not. When we look down here at the liabilities, especially the non-current liabilities marked in yellow, these liabilities did jump up quite a bit since September last year, and this has mainly to do with the acquisition of Naturium. But still, when we subtract the cash equivalents from the long-term debt and compare it to the EBITDA, e.l.f. is currently sitting at 0.8 long-term debt to EBITDA multiple. So this is still a very, very low multiple, and very nice to see, especially for a company that just recently had such an acquisition. Unfortunately, we cannot say the same for the diluted shares outstanding, because the shares outstanding have only ever increased since the inception of the company. The CAGR for the share dilution over the last couple of years was actually around 3.5%. The forecast of the company and the analyst expectations also look quite nice. Here we can see overall growth numbers of the company are expected to be in the double digits, at least until 2025. And the same is actually true for the revenue. Here the growth numbers are expected around 20% for the next couple of years. What I don't like very much about the company is the huge amount of stock-based compensation that they pay. When we compare the stock-based compensation of almost $37 million to the free cash flow of around $60 million, It makes up more than 50%. So before we sum this all up and come to our conclusion, let's have a last look at the current valuation and the fair value of e.l.f. For the valuation, if you look at the PE ratios for the trailing 12 months and the forward PE ratio, it currently sits at a multiple of around 75. This is way higher compared to the sector median, which can be explained with the huge growth numbers. But compared to its own history, this multiple is actually on par with the 5-year average. The EV to EBITDA ratio is also quite high and sits at almost 5 value of their competitors. And even compared to their own history, these values seem to be quite elevated. For the price to cash flow, it is the same. Here we have a huge valuation compared to the sector median, and even compared to the history of the company itself. It's almost triple the value that we had in the past. For my fair value calculation, I actually used the growth rates that we had on average over the last 5 years, even though we just saw in the numbers that these growth rates have fluctuated quite some bit on a year-over-year basis, and we had a huge jump only in the last fiscal year. For the multiple values, I also used the 5-year average value that we just saw for price to free cash flow and also for the PE multiple. And with these assumptions, we come to a fair value of around 233, and by including a margin of safety of 20% to around $186. Actually, I would like to correct down the net income growth rate a little bit, because I don't expect that the company can continue to grow with a 40% net income growth rate over the next 10 years. So let's maybe cut this down in half, because a 20% growth rate over 10 years is still quite a significant value. And I'd rather do my estimations here more on the conservative side. When we use these numbers, we actually come to a fair value of around $137, and by including my margin of safety of 20%, it's only at around $110, which is quite a bit below the current stock price of 167. So from a fair value point of view, the company also seems to be quite expensive right now. So to sum this up, the growth of the company was very strong over the last 5 years, but this trend is also quite erratic, and a large chunk of this performance only came in 2023 with the acquisition of Naturium. They did manage to pull off this acquisition without loading on too much debt, and the balance sheet still looks quite clean with only 0.8 times long-term debt to EBITDA. The free cash flow yield, however, sits at a very, very low 0.6%. It seems to me that the company right now is at a turning point and is laying the foundations to become one of the bigger players in the beauty industry. I also believe that the low price, high value proposition and the way they are marketing is very appealing to younger customers, Gen Z customers. So e.l.f. might be on track to be to Gen Z what Estée Lauder was to boomers and what L'Oreal was to millennials. With most of the revenue currently generated in the US, a global expansion could further fuel the growth over the next years, and the same is actually true if the company manages to expand their customer base from Gen Z also to older customers. For high growth companies like e.l.f., I find it very hard to estimate the fair value. Because on one hand, the growth of the company was very erratic over the last couple of years, and I also find it very hard to estimate the future growth with any kind of certainty. But even though the company still looks quite expensive even after their recent pullback, many analysts are still issuing a buy rating. I myself am not invested in e.l.f., mostly because of the highly competitive nature of the beauty industry and the missing mode of e.l.f. Even though the story of e.l.f. is a great one right now, I think it could be over at any time, and bigger companies such as Estée Lauder or L'Oreal could basically jump on the same marketing strategies as they do. Besides that, at the current valuation, I just think there are better options out there, especially from a risk to reward point of view. But please, before investing, do your own analysis and only use this video as a starting point for your own research. That being said, thank you so much for watching, guys. If you did find today's analysis helpful, please smash the like and the subscribe button in order not to miss my next video. And if you're still looking for a company that might be a good fit for your long-term portfolio, check out this video.